Hello everyone, and welcome back to the channel where we demystify the complex world of finance, especially when it comes to short squeezes and hard to borrow stocks. Today, we're diving deep into a fascinating case that's landed on our radar with an eye-popping cost to borrow fee, BIYA International Group Inc., trading under the ticker BIYA. We're going to break down exactly why BIYA is showing up on our screens, what those high fees mean, and what factors traders are watching. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start with the company itself. BIYA International Group Inc., or BIYA, is a technology/software application company with a market capitalization of $97.02 million. Based in China, BIYA, through its subsidiaries, provides essential human resource services like job matching, entrusted recruitment, project outsourcing, and labor dispatching to businesses and organizations. They handle everything from human resource management and payroll to electronic contracts and pay slips. So, it's a solid business in the HR solutions sector. What is cost to borrow and why it matters? Now, let's talk about what makes BIYA particularly interesting right now. It's the cost to borrow fee. For those new to this, when a short seller wants to bet against a stock, they first have to borrow shares. The cost they pay to borrow those shares is called the cost to borrow, or CTB. This fee is expressed as an annualized percentage and it's paid daily. A high CTB indicates strong demand from short sellers to bet against the stock combined with a limited supply of shares available to borrow. When the CTB skyrockets, it means lenders are demanding a premium because the shares are becoming scarce. Why the stock is hard to borrow right now? For BIYA, the annualized cost to borrow fee currently stands at an astounding 682.1%. That is an exceptionally high rate, suggesting intense pressure in the borrower market for these shares. While we don't have information on the exact number of shares currently available to borrow, a fee this high almost always implies very low supply. Adding to this dynamic, BIYA has a relatively small estimated float of just 2.7 million shares. A small float means there are fewer shares in public hands, making it easier for borrowed demand to quickly outstrip supply and drive up those CTB fees. Our internal composite squeeze score for BIYA sits at 49.2 out of 100, reflecting the significant CTB but also considering other factors like volume and price action. Squeeze mechanics explained. So, how does this potentially lead to a short squeeze? When short sellers borrow shares and sell them, they're hoping the price drops so they can buy them back at a lower price and return them, profiting from the difference. But if the price starts to rise, or if the cost to borrow becomes too expensive to maintain their position, short sellers face increasing pressure. They might be forced to cover their shorts, which means buying shares in the open market to return them to the lender. If many short sellers are forced to cover simultaneously, this sudden surge in buying demand can rapidly drive the stock price even higher, creating a short squeeze. Dilution risk check. Before getting too excited, it's crucial to check for potential dilution. Dilution occurs when a company issues new shares, which increases the total share count and can depress the stock price, essentially making a short squeeze harder to achieve or sustain. We've run our checks and found no recent dilutive SEC filings, no S-1s, S-3s, or 424 BS within the last 90 days for BIYA. This is a positive sign, as it means the company hasn't recently flooded the market with new shares that could offset potential upward price movement from short covering. Recent reverse split watch. Now, this next point is very important for BIYA. The company executed a 1-for-10 reverse stock split just 20 days ago, on July 13, 2026. A reverse split reduces the total number of outstanding shares and, consequently, reduces the float. It also resets the share price higher. Historically, many microcap stocks like BIYA tend to see renewed volatility or even a price pop within about a month after a reverse split, as the market adjusts to the new share structure and price. While this is a common pattern observed in some specific instances, it is absolutely not a guarantee of future performance. It's simply a dynamic that often introduces more speculative interest. Again, a quick reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. What should we watch for with BIYA? Despite the high CTB, the recent price action has been bearish. Today, BIYA is down -5.82%. Over the last 5 days, it's fallen -18.47%, and over the past 30 days, it's down -17.68%. Volume has also been notably low today, with just 1,228,400 shares traded, which is only about 0.1x 30-day average volume of 10,216,933 shares. This low relative volume indicates a lack of significant buying or selling pressure compared to its typical activity. For a squeeze to materialize, we typically want to see an increase in buying volume and positive price momentum, which are not currently present. Remember, a high cost to borrow doesn't guarantee a squeeze. It can also signal that short sellers have very strong conviction and are willing to pay a premium to maintain their positions. So, BIYA International Group Inc. B presents a compelling situation with its sky-high 682.1% cost to borrow and small 2.7 million share float, especially coming off a recent reverse split. While the current price action and volume are subdued, these are the types of characteristics that often catch the eye of traders looking for potential volatility. It's a reminder that understanding the mechanics of these markets, the underlying company, and all the factors at play is crucial. If you found this breakdown of BIYA insightful, please give this video a like, subscribe to the channel for more unique deep dives into hard-to-borrow stocks, and let us know in the comments what other tickers you'd like us to analyze. Thanks for watching, and we'll see you in the next video.